It happened. The Federal Reserve decided to hike the federal funds rate 75 basis points. What does that mean exactly? Well, let me break it down for you. Hi everyone, my name is Tommy. I'm with Aviara Real Estate, and today we are going to be talking about the Federal Reserve, interest rates, and inflation. Before we begin, please give this video a like. This one took me a long time to make, so your support would be greatly appreciated. So let's begin with inflation. Over time, goods and services like groceries and gas and housing, they get more expensive. When prices go up, our dollar can't get us what it used to. That's what we call inflation. You ever notice that a foot-long Subway sandwich isn't $5 anymore? Now, one of the ways we track inflation is by looking at the Consumer Price Index, or the CPI report. The CPI report measures the average change in price in goods and services. We got the CPI report for August, and inflation came in a lot hotter than expected, meaning that things are getting more expensive faster than we anticipated, and frankly wanted. Now let's talk about the Fed. The Fed, or the Federal Reserve, is the United States Central Bank. Their job is to maintain stability in our financial system, and part of that is managing inflation. Now, the Fed likes to shoot for 2% year-over-year inflation. To them, that's a healthy amount of inflation. Now, we got the CPI report, and it says we have 8.3% year-over-year inflation, so that's really not good. Now, one of the ways the Fed can control the situation is by increasing the federal funds rate. By doing that, they're making it more expensive for people to borrow money. It's harder to take out a business loan or a personal loan with all of this interest. In turn, this would slow the economy, which in turn would cool inflation. Now, we got into this mess in the first place because the Federal Reserve kept the federal funds rate too low for too long during COVID. As a result, we got an overstimulated economy and rampant inflation. Now, the Fed has to correct their mistake. They have to raise the federal funds rate until inflation calms down. Now, here's the impact of that. The federal funds rate is one of the most important interest rates in the economy. It affects employment, it affects economic growth, it affects the stock market, and it can affect mortgage rates. So how do the Fed rate hikes affect mortgage rates? So mortgage rates, or the rate of interest on your home loan, they fluctuate up and down daily. Mortgage rates react to a variety of different reports and economic updates throughout the week, both domestic and global. So the federal funds rate moved up and mortgage rates followed. A 30-year fixed rate mortgage, on average, is sitting at 6.7%. This is the highest we've seen them since 2008. Now, how does this affect the housing market? Well, right now, it's really expensive to take out a home loan. Just last year, a buyer who wanted to take out a $600,000 loan at 3% interest, they'd have a monthly payment of about $3,000. Today, to keep that same $3,000 monthly payment at a 6.7% interest rate, they would have to settle for a $400,000 loan. So that buyer, they just lost $200,000 of purchase power. You can best believe that the housing market, they're gonna see some headwinds. The question is, how severe? Well, experts suggest that home prices are actually going to appreciate in 2023. Do they know something that we don't? Will raising rates this high actually push our economy into a recession? And will a recession force the Fed to lower the rates again, to stimulate the housing market again? Fasten your seatbelts, folks. I am dying to see how this story ends. Thank you so much for watching. Please give the video a like. Please subscribe to the channel, and I'll see you next time. Cheers!